Hello, I'm Ron Wilson and welcome back to PD Sessions. The federal government has made available various forms of financial assistance to businesses and households to help them recover following the destruction ex-tropical cyclone Oswald unleashed on Queensland and northern New South Wales. In economic developments, the RBA left the cash rate unchanged as risks in the global economy waned. Internationally, the US share market rallied close to a record high as the jobs picture and manufacturing sector improved. Meanwhile, ASIC released guidance for advisors and licensees on complying with FOFA's fee disclosure statement requirements, and the ATO clarified uncertainties on minimum shortfall rules for pensions. Victoria Papandreou has the details.
Victims of wild weather, including businesses and households, may be eligible for various forms of financial assistance being offered by the government in the wake of the devastation caused by ex-tropical cyclone Oswald. Over 50 local government areas, or LGAs, in Queensland and northern New South Wales are eligible for assistance. The packages available vary from LGA to LGA, but may include clean-up and recovery grants up to $25,000 for small businesses, primary producers and not-for-profit organisations, concessional business loans up to $250,000 for small businesses and primary producers, one-off payments of $1,000 per eligible adult and $400 per eligible child, disaster income recovery subsidies, which provide an ex gratia payment equivalent to the maximum applicable rate of New Start allowance or youth allowance to eligible employees, small business persons and farmers who experienced a loss of income, and grants of $5,000 per household under the Essential Services Safety and Reconnection scheme to help restore essentials such as electricity, gas and water. The types of assistance available depend on how badly a particular LGA has been affected. Most payments have eligibility criteria which must be met. To check eligibility, visit disasterassist.gov.au. The RBA left the cash rate unchanged at 3% in February as downside risks to the global economy abated considerably in recent months. However, the central bank signalled it's ready to ease policy to support the local economy if needed. Governor Glenn Stevens said the RBA judged it was prudent to leave the cash rate unchanged despite inflation being under control, unemployment edging higher and the bank's forecast for below-trend growth in the coming year. This is because the full impact of the 1.25% worth of rate cuts made in 2012 will still take further time to become apparent. Internationally, US shares rallied to near record highs as investors became more optimistic about growth prospects for the world's largest economy. Employers hired a net figure of 157,000 workers in January after a revised 196,000 gain in December and a 247,000 surge in November. Still, the unemployment rate rose to 7.9% from 7.8%. A separate report showed US manufacturing activity hit a 9-month high in January after the Institute for Supply Management's Manufacturing Index climbed to 53.1. The data fueled investors' optimism, pushing the Dow Jones Industrial Average and S&P 500 close to their all-time highs. News wasn't as rosy across the Atlantic. In Europe, the Netherlands was forced to rescue its fourth biggest bank. The Dutch state pumped €2.2 billion into S&S Real after its financial strength was drained as falling property prices eroded its real estate loan book. Looking to Asia, China's economic growth accelerated for the first time in 2 years as the government's stimulus measures and investment in infrastructure boosted activity. GDP expanded 7.9% year-on-year in the December quarter, up from 7.4% in the third quarter. The figures help quell concerns the nation would experience a hard landing. In Australian government announcements, new legislation aimed at facilitating the growth of the retail corporate bond market in Australia has been released for consultation by the Treasurer Wayne Swan. The reforms introduce a streamlined two-part disclosure regime for offers of simple corporate bonds, make changes to the civil liability provisions in respect to corporate bonds issued to retail investors, and clarify the application of the defences in respect to misleading and deceptive statements and omissions in disclosure documents related to corporate bonds issued to retail investors. These measures form part of the government's commitment to develop a deep and liquid corporate bond market. In regulatory developments, ASIC has released guidance for advisors and licensees on how to comply with Fee Disclosure Statement, or FDS, requirements under the FOFA reforms. Regulatory Guide 245 outlines the requirements that will apply to AFS licensees and their representatives who receive ongoing fees from retail clients they have given personal advice to. RG 245 explains the FDS obligations and when they apply, who must give an FDS, the circumstances giving rise to the obligation to give an FDS, and the information that must be disclosed in the FDS. A number of uncertainties regarding pensions that are deemed not to have existed in a year in which the SIS standards were not met have been clarified by the ATO. If any of the requirements of the SIS regulations are not met in an income year, both of the following apply. A super income stream ceases for income tax purposes. The trustee is taken not to have been paying an income stream at any time during the year. Generally, this occurs when the minimum pension has not been paid or a transition to retirement pension has been overpaid. The ATO clarified that in some circumstances it will allow the breach where all of the following conditions have been satisfied. The trustee didn't pay the minimum pension amount in that income year because of either an honest mistake led to a small underpayment or matters outside the trustee's control. The entitlement to the pension's exemption would have continued but for the trustee not paying the minimum payment amount. When the trustee became aware, or ought to have become aware, that the minimum payment amount was not met, a catch-up payment is made as soon as practicable. Had the trustee made the catch-up payment in the prior income year, the minimum pension standards would have been met. The trustee treats the catch-up payment, for all other purposes, as if it were made in the prior income year. The trustee can self-assess where those conditions have been met and they have not used this concession before. All other cases will need to be referred to the ATO.